Hi, I'm Lisa Anderson, president of ASCM-Inland Empire, also known as ASCM, the Association of Supply Chain Management. We're thrilled to be here today with a very important topic on what's happening in the transportation marketplace, and we have an expert speaker with us as well to talk about it. So I'm going to introduce him, and then we're going to go through a presentation. If you have questions, please put them in the chat, and we will intersperse them as it makes sense throughout the presentation or at the end. And we will get going. So let's see here. So today we have Jeff Leppert with us. He has over 25 years of supply chain experience. Jeff leads multinational strategy and operations as Executive Vice President of Modal Operations at Redwood Logistics. He develops commercial strategies and execution, creating value and driving efficiency for customers. So welcome, Jeff, and we're very excited to hear what you have to say. There's certainly plenty going on in the world of supply chain and transportation in today's world.
You're not wrong. It's entertaining. It's like prior to the pandemic, I would tell you that supply chain was on the board decks for most organizations, but it was kind of the last page or the appendix. And then after the pandemic and the stress that most supply chains took, I would tell you that it's probably the front page of most board decks for most organizations right now. So you're right. There's a ton going on, and thank you for the opportunity to take a little bit of a deep dive into the corresponding modes in the supply chain and some of the material impacts that we're seeing. So I will kick it off here. See if I can't get my screen to go here. There we go. So we'll start a little bit on the major trends or macro trends that we see. This should come as a surprise to no one, but obviously the international trade with the new executive office is front and center. Most organizations are experiencing immediate decision points that they need to implement in their organization, whether it's inventory levels or production levels from all countries globally that touch the United States, including the countries that are naturally connected to us in Canada and Mexico. So I'll speak a little bit to Mexico in a different slide. But we have had decision points with customers that have said, what would you recommend we do? And, for those areas where the tariffs made material impact, the answer is stop shipping. And you'll see that in some of the volumes and some trend lines that we see. But this noise isn't going away. I would tell you that it's going to continue, certainly for the calendar year of 2025. And then as these tariffs do solidify and are rolled out, I think organizations that are impacted by that are going to need to make decisions as it relates to their cost of goods, right? So if you're going to pay more for an import from China, you probably need to raise your rates, which will speak a little bit to another point we'll make on the next slide as it relates to consumer spending. The uncertainty in this space is reciprocal in nature. So the consumption side of the fence or the export side of the fence is also material impacted. And it also all these financial markets and supply chains are tied together. And so I think the second bullet point in the trade policy uncertainty that I have here is kind of important, which is it's a global growth forecast that is below the recessionary threshold, which is a word most people don't say recession in a recorded conversation. I have no problem saying it. But the point is that the growth is tepid at best. And it's going to stay like that for a while until we find some stability in what we consider to be global commerce. Domestic trucking, it's the largest segment of the United States supply chain is the trucking, and it's its own ecosystem. And I'll speak to that. And it's a little bit of a supply and demand curve that we have in a chart that we monitor, but it's its own ecosystem. The surface transportation, everything at some point in time ends up in a truck, and I mean everything. And so because of that, we want to always keep a close watch on the supply and demand curve and economics of that. And I would just tell you that one's been interesting for about 3 years. In a post-pandemic world, I would tell you that the trucking industry still hasn't figured out what's going to happen, except to say this: demand is weirdly showing signs of strength, and we have an oversupply problem that we're trying to address. in a inflationary world and rising cost world. So it's weird. The indicators in that space are stale, I guess is the best way to say it, because of the fact that we just don't have that, what we would consider to be a black swan event that would cause a ripple effect somewhere. And then the last comment I would tell you is that we certainly, despite these trade tariffs and global uncertainty, I would tell you that we are, for all practical purposes, back to what we would consider to be a traditional supply chain seasonal peak shift cycle that we're always in. So meaning the summer season is here. So anybody in the summer goods should see a surge. Back to school is being restocked. Halloween is being restocked. Peak season is looming. Inventory levels we watch or paying attention to, they're down, but they're going to restock as well. But I would tell you that prior to the pandemic, when everything kind of resets, we didn't have a cycle. We were just panicked, right? We were in steady state panic. And I would tell you, we've come off the panic mode. It's stabilized. And now we're starting to see very traditional shipping cycle patterns that we would consider to be what I would say old hat for those of us that have been around a while.
So you're saying you think the panic is worked its way through?
The panic from the tariff has not worked its way through, but the prior to the tariff, we would tell you that panic is gone. The pandemic panic, customer supply chains not being stable. The tariffs certainly are creating a little bit of instability, but it was a shock and awe moment, right? So it went from traditional patterns to nothing to now we're back to kind of normal patterns, and we're starting to see that again. But that's not to say that they won't change again as these tariffs start rolling out. Like the recent update on the tariff from China was 55%. That's huge. That's a big number for companies that import goods from China.
Yeah.
From a macro indicator, and again, I'll kind of I'll speak high level to a high level some KPIs here, but obviously from a Redwood perspective, for all of our customers, we want to make sure that we're looking at macro trends. It helps us predict the future. It really does help us lay a strategy out as it relates to where customers should be paying attention to core components of their supply chain. A couple of key ones that we look at, obviously GDP is important because it speaks to overall health, but it's a little too macro to make a business decision off of. Where I would tell most individuals to kind of bring down their vision and line of sight to is inventory levels and inventory to sales ratios. And then obviously on the bottom two I really like is the consumer price index and the personal savings. This is, for lack of a better way of saying it, overall demand, right? So if the American consumer can't afford to buy things, they are going to buy less, or they're only going to buy the important things. And you see those two red indicator lights that we have here. That it's not a positive trend line that we have in those two spots, because as everybody on this call can attest to, everything's more expensive. So, and the other thing I would comment on, and it's an important segment for everybody that's in this space to understand, is that like social media changed the American buying behavior. And so instead of buying second homes, instead of buying jet skis and boats and like Corvettes, you're seeing individuals spend money on experiences. So even as the consumer price index climbs and the personal saving rates decline, I would counsel everybody to say everything's more expensive and they're buying less anyways, because of the fact that the dollar doesn't go as far. And if I have an extra ruble or an extra dollar somewhere, I'm actually going to spend that on taking pictures in and then insert your favorite destination. And I believe that demand dollar is going to continue to rest in that tourism lifestyle experience and not necessarily in an actual product world for manufacturers and such. When we look at the demand rates, demand versus rates, this is important. It's not demand and supply, but it's demand and rates. And so on the demand side of the fence, this is what I was commenting about personal goods expenditures. They're more expensive. And that trend line continues to demonstrate that it's there's less for more dollars, but it's also declining. Sorry, it's gonna move my Zoom window. It is it's going up, but again, it's not necessarily going up because of the fact that we're buying more. It's because it's more expensive. And you can see that in that upward tick, but it also does mean that individuals are buying what they need to buy for their day-to-day lifestyle. The TEU index, this is just basically imports from Asia. You'll see that in a year-over-year comparison, it's up pretty significantly. That's more of a timing mechanism and not necessarily a trend line. But I would tell you that that we watch that. That is a leading indicator of two things. One, a traditional peak season, meaning Halloween's on the water. Halloween was probably on the water last month, now that I think about it. But long and short of it is that we're pulling forward what would be traditional seasonal patterns. And then you're also watching import levels, right? And then the import levels by default lead to inventory or lead to production. And as long as that's going up, that's a positive thing for us. And you'll see that it went down drastically in February. It's going to go down again in May because that'll be the first time we report this KPI in this chart based off of the tariff turmoil. And then you'll see it come back up to 2 or 2.1 as June presents itself. So freight's moving. It definitely is moving. The next KPI that the Cass Freight Index, this is a fantastic index for those of you. And a lot of things I'll talk about today are designed for people who are listening to do themselves. I'm more than happy to do this. Redwood is more than happy to help as well. But these are KPIs that are available to the public. So I'd like to frame these charts out for individuals if they find value in something that may tie to the decisions and strategy that they need to build and make. So the Cass Freight Index is basically a lot of organizations report their volumes and rates to Cass, and Cass comes up with a shipment freight index that indicates overall shipment count in what they audit overall. And so this is an activity trend line that we're looking at, and you'll see that it's muted, but that is paid historical actual volume, not a forecast or a trend. So it is a very real number when we're looking at it. The Logistics Manager Index is a very similar concept here. This is just basically showing, in my opinion, that rates are climbing, and rates are climbing for a number of reasons, and I'll speak to that in a second. When you look at the rate side, DAT is a industry known KPI as it relates to the truckload market. And I think here the trend over time is probably the beacon I want everybody to kind of frame in on. And that trend over time is you'll see these rates are just continue to come down, both in a contract world, which is fixed dedicated rate capacity, and obviously in the spot, which is the default of a supply demand economic that triggers the supply or the spot rate decline. And you'll just see that one should follow the other. So if demand goes up, spot should go up, but as spot comes down, contract comes down, and we'll show you another point to that on the next slide. But you'll see these rates are coming. For those of you in the procurement world who are looking for reduced costs, this is a fantastic area because rates are down. Carriers are looking for committed capacity, and this is a fantastic opportunity to face the market in all modes, but in truckload in particular. All right, I'll jump into the next slide. This is a great chart as well for those of you that are interested. This is from FreightWaves. FreightWaves, the blue shaded area is overall economic output in a surface transportation world. So this is the United States truckload push, if you will, on a daily basis. You'll see it's down, and that speaks to raising rates and overall consumer sentiment. And then the yellow line is the impact of the supply constraint as well as the spot market. So as the demand goes up, spot should climb. You can see that in a lot of points here, but you'll also see that the spot is really more volatile than it's ever been and closer to contract. And that is usually a sign that the market's about to shift and rates should start climbing. But as you see to the far right, you'll see that spot line is not going up. That's the rejections. That is starting to flatline or plateau, which means there's a softening in demand. And so that's an important KPI to look for, especially in what we consider to be a pretty active month that May is. So that's not necessarily an alarming number to me. That just means that we're going to continue to have what I call static or flat outlook for the rest of the year. All right. So this is the employment and Class 8 or truck production corresponding to a rate. And so the green or the red line and the top chart is our contract rate, and the yellow line is our spot rate. And then obviously you have your employment numbers in that space. And a couple of comments that I'll make is, one of them is you'll see prior to the pandemic, which is those really tall blue bars. Prior to that pandemic, we didn't have a ton of volatility. We had a brief, weird moment as it relates to the ELD rollout and strategy and Hurricane Harvey that hit. That's those blue bars in 2018. And then you see the pandemic, which was just kind of seismic. But what I really want individuals to focus on is the fact that the amount of bars in that cycle, you'll see that these cycles are longer than they have been in the past. Usually we had quick reactions. And now you're starting to see this long tail or trough in both the up cycle of the pandemic and now the current down cycle or unemployment increasing, for lack of a better way of putting it, in these blue bars. But you'll see that it's coming back. So we're at kind of that fulcrum, if you will, that pivot point of the market should shift. But there actually is a number of people, myself included, that expect this to continue for a little bit longer. So I do think that this calendar year will continue in a very soft, muted state, which is a fantastic time to look at supply chains, cost, procurement, optimization, modeling, nearshoring, center of gravity studies, whatever you're interested in. This is a fantastic time to take a deep dive because we have a little bit of stability in order for you to secure, relationships, pricing practices, if you will, for the instability that is coming. But short of a black swan event, the volatility shouldn't come back here. And then on the bottom right, you'll see that this is the Class 8 truck build versus volatility. So all this means really at the end of the day is when rates are high, when the load to truck ratio, that orange line, peaks, that means rates are elevated and it's profitable to be in the trucking industry. So the second that happens, what you traditionally see is the blue line react and people start buying and building new trucks. And so they are directly correlated to each other. As the orange line goes up, the blue line should start to follow. And then as the blue line stays elevated, sooner or later, the rate stays suppressed. And you'll see the Class 8 orders and new builds go down because it's not profitable to be in the trucking industry. So it's just tied together in a very good correlation. But I think for me, it's kind of like the infinity symbol. If you look at those ups and downs that this is taking, we're on the down cycle, which means that this should go back up, which again means we just need that one moment, that one trigger that creates stability. And we should start seeing rates start climbing. And then subsequently Class 8 trucks would swing back in the other direction. But this is a fantastic A and B comparison on how the trucking industry creates capacity based off of rates. I don't have line of sight to questions, Lisa, so I'll defer to you. If there are any, just let me know. I'm happy to do it during the presentation, or we can do a Q&A after. I'm happy to defer till then as well.
Well, so it sounds like so far that there's a lot of opportunity for renegotiating rates and getting a better cost structure.
There isn't a mode. Ocean, parcel, LTL, truckload, you name it. There isn't a mode that we are not coaching our customers to strategically look at right now. It is the carriers are thirsting for partners and are thirsting for freight. And they're trying to build stability in their own networks. And if you have freight, you have, to use a Texas Hold'em card, right? You got pocket aces right now. Pocket aces, all the chips. So how you want to handle it. But if I was on the shipper side, and we certainly help all of our shippers, and I buy, well over $1 billion a year in transportation, I would tell you that with my pocket aces, I'm shoving up my chips all in on a regular basis. Load to truck ratio is a great indicator of what it sounds like, loads to trucks. So in a world where the truck isn't necessarily known on where it's going to be at any given time, trucks will post their capacity to a board and loads will get posted to a board and individuals will match the load to a truck. That's what this is an indicator of. So you want to look at the load to truck ratio. Traditionally, it used to be like 2.5 meant we had an imbalance in a material rate impact. I would tell you that that's not accurate anymore. That's shifted then post-pandemic. I would tell you that anything greater than 3.5 means that we have a supply and demand concern. And you'll see here in this world, it's important to parse truckload out into its 3 core segments, which is dry, flat, and temperature controlled. And in the reefer space, you'll see that the load to truck ratio is softening. That we're coming off what is a normal produce season in April, and I would expect that produce to swing back up as everybody and their brother starts growing stuff in the United States because the temperature is nice. And so I would expect the load to truck ratio and reefer, and then flatbed is 100% dependent on the housing market, and the housing market is 100% tied to national interest rates. And as long as those natural interest rates stay high, I would expect that the flatbed market stays muted. But we need people to start buying houses. My brother's in the market and he can't, literally, there is no inventory. Every house that's available, it's sold in 2 days. Nobody's selling their house because nobody can afford to buy a house right now because the interest rates. And that's not that they can't afford it. It's just really expensive to afford it. And you have to make some compromises.
So it's hard to read some of the numbers down there. So you're saying that can you explain that, what you were saying about it used to be a 2-to-1 ratio and now it's
yeah. So if you look at the bottom on the truckload side of the fence, you'll see that in May it is 4.63. And 4.63, what that means is for every one available truck, there are 4.63 loads.
Okay. That seems bad, right?
Yeah. So that just means, what that means is that you should be paying a little bit more, right? And so there is some rate volatility there. My only comment that I would make is it used to be significant at 4 because the national balance was 2.5. But now the national balance is like 3.5. So the balance point came up a little bit. So that point higher to 4.63 isn't as severe as it used to be. 2.5 prior to the pandemic meant rates were going to start climbing. And I would tell you that now it's somewhere in the 3.5 to 3.75 range where we start feeling a little bit of rate pressure. So we do have rate pressure in the marketplace. It's just not significant and it's certainly not volatile.
Interesting. But what logically though, if you have 4 loads for every 1 truck, doesn't that, it sounds like it would be, sounds like it'd be a problem, but
yeah.
it's not apparently.
And this is a great top level, high level KPI. I think it's important to understand that that's a national average, and you can certainly get into markets like Los Angeles where that's really volatile and can ebb and flow, or the Atlanta market took a big swing recently. But like in the Midwest, it's incredibly muted. It's below 3%. Or below 3, I should say. So just know that it's a national average, and every once in a while it's mildly impacted by a dynamic area that is really hot.
Sure, that makes sense.
And so that's the only thing. So for me, it's more about a macro number. It's like, how far away from 3.5 are we is more the best way to look at this.
Well, it's a good thing to understand that 3.5 is the average. Otherwise, it's hard to know what you're looking at. So that's great. Thank you.
And you'll see in the flatbed space that those numbers are significantly higher. Like that's 30, right? And that is just speaks to the amount of dry trucks there are and flatbed trucks there are. So it's more about looking at the ups and downs and the trend there than the actual numbers. So that's what I mean. Like 30 loads to 1 truck means that you should pay $400 a mile for that truck, and you're not. It just means that there is more demand, if you will, in the spot market than there are trucks.
Okay, makes sense.
All right, so I'm going to shift gears a little bit on you and move into a different mode. That's LTL. For those of you in the LTL space, it's actually a great time. There's two big things happening in LTL. It's like for the first time in a very long time, I would tell you that it's a fantastic time to be in the market, and everybody should be in the market. And then I'll speak briefly to a massive industry rating environment that's happening that every shipper or consumer of LTL freight needs to be aware of. But for the most part, on the left-hand side, ArcBest came out and said, hey, listen, we even though tonnage, and I'll speak to it on another slide, is way, way, way down, we are not lowering our rates. And I'm just going to say this. I know it's being recorded, but I'll say it anyways. There's no doubt in my mind that these carriers are very similar to the airlines. They just don't want anybody to go to the bottom first. Once one goes, they all have to follow, and they have all held the line and said, we're not lowering rates. Somebody could. Saia, for example, could absolutely take a race for the bottom, and they would all have to follow, but none of these carriers are interested in doing that, which would beg the question, how often do they meet at a bar to make sure that they don't do this? But they don't do that. That's just me being a little bit facetious. So anyways.
But you're saying that like the loads that are out there are muted or lower, but basically, it makes sense. Why would they want to reduce the price that they're going to get?
Yeah, let me show you this slide. It'll help speak to this narrative. So if you look on the left-hand chart, this is just LTL, not truckload. So again, we're in a world of pallets now. But if you look at the left chart, that is a tonnage chart, and that tonnage is below where it was in 2010. So organizationally, if you're a leader of an LTL company and you're moving that less volume and weight than you did in 2010, you would think the world is coming to an end, especially if I told you that your operating costs are up over 35% from that same time period. So 35% more expensive to run the company, but I have less tonnage than I had in 2010. So the only way to offset that is to continue to raise rates. And you'll see that is happening. These carriers are like, we're not lowering rates. Like, even though we have a tonnage problem and we should be taking a race to the bottom, I want to fill my trucks. They are not. They're actually holding the line and saying, I'm going to continue to raise rates to offset my increased cost, increased wages, everything post-pandemic, that insurance costs, oil, those are the big two. Employee wages is another one, driver pay. They have significant cost increases that they've taken. And so they are not ever going to lower rates in order to bring on tonnage. I would tell you one side story. Saia did lower rates because they had brought on some new terminals they bought from the Yellow bankruptcy. And when they bought those terminals, they went for a volume play. They said, just fill it. And it raised their operating ratio by over 6 points. And I think that was a wide open wake up call for them to say, volume doesn't necessarily mean revenue. Volume does actually just mean increased cost and doesn't necessarily tie to profitability. On the right-hand side, you'll see again, the only thing this is why I think it's a fantastic time to be in the LTL space is because if I know rates are going to go up, then I might as well level set it. And I will go to market now, get the best rate I can, because if rates are going to go up now, from now on, they're going to go up at a very soft rate, right? So it is a fantastic moment to find counsel or run it yourself. But every shipper should be in the LTL procurement space right now, leveraging this little window we have to set a new baseline with carriers. If I had a soapbox I could get on and it was strong enough to hold me, I'd absolutely do it.
So what's your opinion here about why is the market the worst since 2010? It doesn't really make sense to me. I can't think of why.
It literally does speak to the fact that we're just not buying anything. It's too expensive to buy anything. We are in a full-blown freight recession. The American dollar is not going as far as it used to. Like, I just bought a truck. I bought the same truck as I bought 10 years ago, and it was $35,000 more than it was 10 years ago. It's like everything is just more expensive. Milk's more expensive. Christmas trees are more expensive. Everything for my teenage son cost $100. I don't care if it's socks to a backpack, everything costs $100. And that's the biggest issue we have right now, is the fact that everything is more expensive, and you can't buy as much as you used to, right? So
And
now
it looks like that happened in 2024 from this. Am I reading that right?
in this world, yeah, this is post-pandemic high. So we have an artificial high in the pandemic, right?
Yep.
So a little overinflated in the pandemic. And then all of a sudden it came down. Another caveat I would say here, which is really important to comment on, is there's a big bad wolf in the room, and they're awesome. They're just a big bad wolf in the room. Everybody needs to understand who they are, and that's Amazon. So Amazon is slowly but surely taking market share from these LTL companies and moving that freight in their encapsulated ecosystem. I'll speak to it in
well,
the
that makes
slide.
sense to me.
And so you'll see that not only is the American dollar doesn't go as far, so I can't buy as much, but more importantly, the dollar I do have, I'm probably using it on Amazon so that I can get whatever I want the next day on my front porch. So there's a little bit of a buying pattern differential that we have there as well.
Got it. That makes sense to me,
Yeah,
actually.
Lisa, and that's where you're seeing that equilibrium of load to truck go up from a historic basis, because there's an impact of a shorter length of haul, primarily due to e-commerce. So in 24 hours, instead of being able to take 2 loads, they may be able to take 3 or 4.
Yeah, that makes sense. Okay, that makes sense. That's good to understand.
This is producer price index just specifically for LTL. Again, I only speak to this because it's up, and this is just me validating what I was just saying. It's not actually coaching anything, except to just say those that are in the rates or in this space are feeling that their rates are climbing and are feeling that their rates are going to continue to climb. And so this just exacerbates the point that you want to level set what you're doing in the LTL space right now, because carriers are more apt to set a foundation that's decent, and they'll raise your rates over time, but they're going to raise them in a much softer rate and pace, if you will. This is a big one. So for people in the LTL space, the best analogy I can give you, there's a lot on this slide, and I can certainly go into as deep and as dark as you want to go. This is a deep, dark space. So I coach people out of that world as much as I can. But if you're interested, I'm more than happy to go down this wormhole with anybody. But on July 19th, the US government is issuing a new pricing practice for all LTL freight. And that new pricing practice is going to shift everything from a description-based model to a density-based model. So it's going to go from what you call what you ship, your description, if you will, to how much space do you consume on a trailer. You're going to start paying for space. So the best analogy I always give is going to be.
And that wasn't the way it was? I thought you.
So like the old way of doing things, you would put on a bill of lading, I'm shipping a drill, right? And 20 years ago, a drill was made out of solid steel, had no plastic parts, and plugged into a wall, right? And the industry came up with the density of that drill and said, this is what you're going to move that against. This is going to be your, if you will, your discount or class based off of shipping drills. Now the drills you can buy in a checkout lane at Target. They're handheld, and they ship 400 of them to a pallet. Additionally, on that pallet, it's shrink wrapped with a piece of paper that says, do not damage and don't double stack. Right. And so the carriers were forced to rate and move freight at it used to be a steel drill. Now it has, not only is it not a steel drill, it's packaged differently, it's lighter, and it takes up more space. And so the carriers aren't idiots. And over the years, they've already raised rates on these things. So I want to be clear, but they didn't raise rates based off of the description of the product. They raised rates off of their knowledge of the shipper. So they just basically said, hey, we know what that is, and we know it's class 50, but we're going to give you a different discount point because it's not what it used to be. And now the industry is shifting from the carriers saying, hey, we're going to raise your rates and agree that class 50 is the description. Now that basically the industry is saying it's no longer the carrier's responsibility, it's the shipper's responsibility to clearly identify what your density is. And that is what we're going to dictate your new rates off of. Significant change in this space. And for those of you that are interested, there's kind of two worlds that I live in here. Is one of them, and Redwood can do this for you, or seek counselor help your from somebody else. But check out your bill of ladings. It's a bill of lading health check. You need to know what's on your bill of lading. You need to have an NMFC code. You need to have your dimensions, your weights. Everything needs to be accurate. You need to pay attention to the bill of lading because that's the guiding document. And then the other thing is that, you know, we need to pay attention to what the density is of each pallet in order for us to determine the proper class. Big change here.
Well, what do you think this is? Do we have any idea what this is going to mean in terms of prices?
Yeah. It's good. On July 20th, two things are going to happen. Rates are going to go up. And those of the FP&A is going to be a significant talking point on July 20th. Significant. So those companies that are in the FP&A space, you're not going to be able to audit this. So you're not going to be able to fight this. The carriers are literally going to say, I'm right, you're wrong. You have to pay more money. And there's no argument there. You're just going to have to pay more money. And so the FP&A side of the fence is going to be, it's why it's really important to have the shippers need to bring in outside experts to help with what's my actual class? Is it on my bill of my density-based class, I should say? What's my density-based class? Is it on my bill of lading? Do I have my NMFC codes? And am I rating this properly? And am I getting dimensions? And so the FP&A is going to be, it'd be like if I owned just an FP&A only company that was only on LTL, I would be concerned because there's not a lot. You're going to audit everything, but there's no value you're going to create because there is no pushback or fight after you do the one audit on is it right or is it wrong.
What does FP&A stand for? Freight
Pay and Audit. So there are companies that only audit.
I assumed that might be what you're talking about. I wasn't sure. That wasn't familiar. So why? I don't know if you know this, but why is this? You know, where did this come from, or why is this happening?
The carriers are sick and tired of not getting revenue on the cubic capacity used on their trailers. And so
it does make sense.
They lobbied for years to get this, and they finally got it. It's a carrier decision in order to go back to my tonnage point, right? Tonnage is depressed below where it was in 2010. Costs have gone up by 35%. They need the shipping community to start paying for space used on a trailer. And so they lobbied the government and got the NMFC to change the way things work.
Got it. Well, and I wonder how this will relate to Amazon, because I guess they absorb the cost anyway. Currently, is that what happens basically?
Yeah, I mean, Amazon's more of a B2C world, and very few people buy LTL size shipments, right?
Yeah. Well, that is true, actually.
Yeah, but it doesn't mean that Amazon's not in the LTL space. But Amazon's so rich and so smart that they already know this. So the LTL freight they have in their network, they have dimensions. It probably goes through a dimensioner, and they are actually saying, we've got this. We know exactly what this is, and this is the density, and we're willing to pay for it. And this is what we're willing to pay. And if you're not willing to take that rate, we'll move it on our own truck.
Yeah, makes sense.
Yeah, they have the luxury of, as they're building out, being selective as who enters their network and how that shipment is packaged and identified. So when you're starting from scratch, as they are, they have the opportunity really to control what enters into their network.
Yeah, that makes sense. But I can see what you guys are saying, because it's going to affect the manufacturing space and, like, you know, business to business. Like you said, B2C is a different animal, really. But I see what you're saying, that I mean, it affects this, but
the LTL space is going to be a B2B world. Or to your point, a manufacturer to dealer or network kind of world. All right. So another thing that's important to pay attention to is the price of oil. Like, oil skyrocketed today because of the turmoil in Israel. Like, it's very real. But oil is the number one, diesel is the number one expense in a supply chain. And because of that, and it's a byproduct of oil, I am a huge proponent of the price of a barrel of oil is more impactful to the rates in all modes of a supply chain than anything else. And so as long as oil stays mute and you have an executive office saying, hit it, open every well and bring it in, right? They're replenishing the United States reserves. They're going to tap every well possible. They're loosening restrictions. That is not good. That's going to keep the rate of oil down, right? And so that's a good thing as it relates to the cost, right? The cheaper the oil, the cheaper the gas. Which is good. It frees up money in the American consumer world. They get to, instead of spending $100 at a pump, you're spending $55 at a pump. That's a fantastic thing. You have some money for food. So it all ties together and it all comes off of oil. So I am a huge proponent of watching the price of a barrel of oil, or in this case, US diesel. And as long as we stay in this world where it's kind of sub 3.6, I would tell you that we're not going to have a significant amount of pricing pressure. But the second oil goes up and hits the $80, $85, $90 a barrel, and diesel prices start climbing back up above $4.50, all rates and all modes outside of the fuel surcharge will also go up. It's not just fuel surcharge. It is an immediate pull on the base rate. Yeah,
that makes sense. And I guess it kind of depends on the geopolitical issues going on, but
100%. There are like 8 guys in the Middle East that can make the change that they need to make, and they all get together and they tell the world what they're going to do, and we all react and consume. There's no other way around it. But sooner or later, at least, we're going to run out of oil. So like it's a dynamic we have to pay attention to. But there's like 8 wealthy families that control most of what we spend in this space. All right, from a parcel side, it's actually kind of interesting on the parcel side. A lot of people don't understand the size of Amazon, but we got this slide, and I love this slide, and it just is a fantastic visualization of what's happening in parcel. You'll see that the United States Postal Office is still that quiet giant. The most packages in the United States still live in the U.S. Post Office. 2 reasons for that. One, most of the packages are actually really, really small. They fit in your mailbox. So the earrings and the chapsticks and stuff like that. So most packages traditionally are pretty small. But the other thing I would comment on is the fact that they do still have an entire network that touches every home in the United States. And so because of that, their footprint is bigger than everybody else's. And Amazons of the world's, the FedEx of the world's, UPS of the world's don't want to drive to the middle of or Western Illinois or the middle of Iowa. It is an inefficient use of time, resources, gas, etc. So you'll see things like, hey, we're going to start using drones for that. So like Walmart is coming out saying drones are coming. That actually makes sense. The only coaching moment I would give Walmart would be in certain states, those drones are going to get shot right out of the air, right? So there's just people that are like, nah, no thanks, drive it to me, right? And so you just have to be careful on drones aren't going to take over the world, but they are being strategically looked at because the footprint of these other carriers don't compete with the USPS. But the other talking point to this chart is the fact that Amazon's second, and it's not going to get any smaller. So
they've been building up, over the last several years.
They are significantly more and more impactful in this space. And so you'll see if you ever read an earnings statement from FedEx or UPS, they are not expanding. They are not looking for introducing new products and services. They are on cost control mechanisms because the market share that they're in is going to continue to get smaller as that B2B space with Amazon gets bigger. So they're fighting over a significantly smaller pie between the two of them. And a great story is the second bullet point on the left-hand side. FedEx was the first company to throw Amazon out. They saw Amazon in a full-blown negotiation as a threat and said, we're out. And they threw out Amazon. Amazon then went to UPS. UPS just recently said, you're out. And then FedEx brought them back. So FedEx basically said, wait a minute, we need to grow. So we are going to bring you back in. And this was a very interesting dynamic that I didn't expect to happen. So I was a little taken back by that. But it doesn't surprise me as these individuals continue to fight for a declining market share, because Amazon really is going to be the one that grows here as it relates to volume count.
Yeah, interesting.
The last piece I'd say on the parcel world is basically they're like tricksters. They change rates, they change tariffs, they change contracts terms, they change everything. And there are a number of people out there that can help with the negotiations of those contracts. And I would tell you, absolutely get in the market, save some money, and get after it a little bit, because these guys are going to do anything they can to make a buck in a world where they can't. They're losing volume count. I'm coming up on time, so I don't want to move too fast through a couple more slides, but I do want to be cognizant. From a Mexico side of the fence, the only thing I would tell you is that Mexico is going to continue to skyrocket. It's already the United States' #1 trade partner. It's going to continue. It's remarkably convenient. The dynamic is fantastic. It's all surface transportation. Laredo's incredibly efficient. They're investing heavily in San Diego. Like, this is not going anywhere. And on the right-hand side, you can see all these major organizations that are nearshoring, and they're going to continue to nearshore. Like, Mexico is very real. Now, the only other point I always make on this slide is, despite being the biggest and probably likely the fastest to grow, it is also 100% unregulated. There's no US DOT. There's no Mexican DOT. There's no nothing. It is the wild, wild west as it relates to regulation, hours of service, rates, insurance, theft. Wild, wild west. So you definitely want to have people that understand that space to help with strategic movement of goods. This isn't about market like rate pressure. This is literally about the effective movement of anything in a supply chain. You need Mexicans to do that. Hiring people from, I'm just going to say, upstate Michigan to set up a Mexican network is not going to work. You need Mexicans to do that. It is a cultural thing. It's not bad. I'm just saying it's the way it works. The last comment I would make is, there was something called the B1 driver, which was a Mexican truck driver that had the ability to drive into the United States, make his delivery, but was required by law to return immediately to Mexico. No stops, no nothing. He had to return immediately. And the new English language speaking requirement makes an impact on that B1 driver, which was a huge supply surge for supply chains, was to have that available driver community that spoke Spanish now have to speak English. And if that goes through and ends up being enforced, we could lose the ability or the amount of B1 drivers that are available in that truckload capacity world.
Well, now I was just going to ask you that. So it sounds like that would be like the Mexican driver, if you will, that follows those rules in quotes, I guess, that could deliver into the US. So of course they're going to be less expensive. So what you're saying is that could get rid of that loophole in a way.
Absolutely. Okay. All right. The last one, ironically, I should probably have more than one slide on this, but it's the global trade, right? So this is steamships. And this is by far the biggest and probably the most, if you will, global, because it's not just the United States that imports and exports. There's plenty of trade between Asia and Europe. There's plenty of trade between Asia and South America. But for practical purposes, this is just basically stuff into and out of the United States. I would tell you that the pandemic, or the tariff, not the pandemic, the tariff impacts here were immediate, obviously, because nobody shipped anything from Asia. But so the steamship lines moved all their vessels into other parts of Asia, the Middle East, to Europe, etc. And now they're just bringing them back. So they created these blank sailings and said, we're not shipping them. Now they have to reposition them all back into Asia, or China, I should say, not Asia. And they're going to start bringing them back online and start creating those strings again. And once they create those strings, the capacity will come back online and the rate, but they are still going to try and raise rates. And so in this space, I would tell you there's kind of three things that we watch. We watch congestion, and the congestion right now is really only material in Asia, or in China, I should say, as you can see on the left-hand chart. Next thing we watch is obviously rates, which is the middle chart, and you'll see that they're down, and they're down across the board. This is a global a demand moment, right? So Shanghai to Rotterdam has nothing to do with Trump, right? And that's down.
Correct.
Shanghai to Genoa has nothing to do with Trump, and that's down. So this is a global demand kind of indicator. But they're all down. They can't stay down forever. They'll start moving these up a little bit as demand comes online. But it goes back to the original point I made in this presentation. We are in what I would consider to be a very soft, not recession, but very, very soft global health moment, whereas it relates to money being out there and demand being high and people buying things. It's a soft world, but I would also coach everybody to sit there and say a lot of spending behavior from consumers has shifted from products to experiences. And so because of that, 20-year-olds are not buying cars. They Uber everywhere. 25-year-olds are not buying houses. They are renting apartments. 30-year-olds are not having kids. 35-year-olds are having one kid instead of four. And so like you have these significant lifestyle changes that are happening that are preventing a huge increase. And they're all willing to spend $100 for a streaming service, which has nothing to do with freight, right? They'll take $100 and they'll buy a YouTube package. But they are not going to take that $100 and go buy new shoes. And so because of that, I think this freight market, as I mentioned through all these slides, is going to stay muted for a while until something happens. Either stuff's got to get cheaper or more money's got to go into the available pool of spending. And even then, you're only going to get a portion of it because the other portion is going to say, I've never been to Paris. I'm going to Paris.
Yeah, makes sense. Well, and interesting. I mean, in a way, this, having all the ships, I guess, in China are being reallocated is good because there's other rules going into effect too, where they're going to have to use certain ships for certain routes, etc., is my understanding. So anyway, it's very interesting.
That's my last slide. So I'm happy to take a question or two if there are any.
Well, I've been asking them all throughout.
Oh, okay.
Sorry. I somewhat delayed you. Sorry about that, but
you're good.
It's been actually very interesting. So I think the takeaway here, tell me if I'm right, but I think the takeaway is that the freight market is, like you said, you're good to say soft, not necessarily recessionary yet, but it's a good time for folks to go in and negotiate, establish freight contracts for the future. Sounds like, etc. And it sounds like there might be a potential in LTL for folks to get.
If you don't know how, reach out. Like you can't miss this opportunity. I can't emphasize this enough. If there's a concern, reach out to an expert, a partner of some kind. I'm not pitching Redwood. I'm just saying somebody like Redwood or Redwood. Find somebody that can help you with it because this is a perfect window for all modes, and so you need to be taking advantage of it. Because rates are going to go up from here. It can't stay down forever. And so you need to reset your baselines now. And then the other second point that I always make to all of our customers is now is a fantastic time. While it's muted, it's a fantastic time to stress everything. So do you have the vendors in the right spots? Consumer experiences are measured and tracked. It is a fantastic opportunity for everybody to test the viability of a supply chain. Not just rates. Rates are first and easy, but the viability of a supply chain should be documented and tested while it's soft like this. It's a fantastic time. My point being is if you buy aluminum from a guy down the street in Indiana, you should be talking to the guy down the street in Michigan too, just in case.
I completely agree. It is a great opportunity to do that and great time to do that. That's great. And I would definitely say, thank you, Redwood, and of course you, Jeff, have been fabulous in sharing all this like very valuable information with us, and folks should take heed. No need to miss this type of an opportunity. So I will definitely start communicating that with clients as well. So thank you.
Fantastic. Thanks for having us.
Absolutely.
Yeah,
Thank you.
Thank you very much. And folks, join us again next month for our next webinar. You can keep track of them on our website, which is apics-ie.org. Thank you very much again to Jeff and also to Redwood.
Have a great weekend.
Thanks, you too.
Bye-bye.